to the Family.Inc Expert Interviews. Today, I have the pleasure of speaking with Dave Sachse. Dave Sachse is a second-generation family member who works at his family's single-family office based in Wisconsin. As an angel investor, founder, and managing partner of Family VC, he has a global community of over 200 family offices collaborating on all things venture investing and navigating family office dynamics. Additionally, he's the managing partner of Sachse Family Fund, a pre-seed seed fund whose LPs are family members. Dave, welcome.
Thanks, Josh, for having me. Happy to be here. Good to see you.
Glad we can do this.
Absolutely.
Today's discussion is titled VC for the Whole Family, the why, the when, and the what to avoid. Before we begin, a little housekeeping. If you have any questions throughout the session, please use the Q&A button at the bottom of your screen. So Dave, let's talk about Family VC. How did you get here? What was the genesis for it? And a little bit of background so everyone has some context.
Yeah, that sounds great. Family VC, it's been a part of my journey. It's a culmination of my career experiences. So I started out actually in the corporate world as a product manager for software, and then I tried to do my own high growth startup. And after that, I became a sales consultant for startups. But on top of that, just stepping back, how I work at my family's family office. So my father and late mother sold a manufacturing company in 2012. Created two core products: frozen ice cream machines that went into Midwest fast food locations, and then industrial washers that wash things like Intel's computer chips or Disney's 3D glasses. So that's how my parents got substantial liquidity and opened up a family office. I have one older brother. Him and I joined the family office about almost 10 years ago now. And we got some capital from that liquidity, but by no means was it substantial for venture investing or anything like that. My wife and I, in turn, got very lucky investing in public securities, largely concentrated positions in technology stocks. So that gave us the firepower to actually get into venture and start allocating. But the genesis behind Family VC has just been, like I said, a culmination of all my experiences. And when I started doing VC 8 years ago, I quickly learned, Josh, that capital is a commodity. And how can I compete? Like being a random family office from Wisconsin, where a lot of the activity happens on the coast, how can I get into competitive deals knowing capital is a commodity? And having just co-investors is table stakes for the best investors. So saying you have a network of co-investors is also not necessarily a differentiator. Another thing is I was learning VC as a person that comes from a manufacturing family. I had a champion VC as an asset class with my own family. It's not like they said, "Hey, yeah, after failing your startup, this is a great idea. Let's invest in these risky things." No, I had to
Let's double down on Dave.
yeah, I had to convince them after 2 years of feeding them content around venture on why we should allocate as a family to venture as an asset class. And then, as you know this very well, and I think Family.Inc does a tremendous job with content and stuff, but navigating family office dynamics when you're working with family members as well as other professionals, it's just there's not a playbook out there for it, and there's a lot of nuances to it. And the old adage goes, as you know, you meet one family office, you met one, and it's nice to have peers that you can chat with that are dealing with similar things, and they're not talking to you because you're paying them an hourly rate.
Yep. Venture and Midwest doesn't always jive. So I love the fact being a Wisconsin guy, I love the fact that you're carving this out. And real quick, are you seeing more and more venture in the Midwest and firms funds getting organized in the Midwest? I'm just curious.
Yeah, I mean, so going back to COVID, I think a positive from COVID is people cared a lot less about where you were and more about the quality of your work. COVID also helped people say, "Hey, I don't like being stuck in a certain area if I don't have the serendipitous interaction." So it actually created boomerang for several successful founders and fund managers that relocated in the Midwest. So I am seeing more formal venture funds set up in the Midwest. In addition to, I am seeing more family offices taking more of a venture fund approach to it, and not like they're playing Shark Tank or just doing it off the balance sheet of the operating business, but actually organizing it like they're a venture fund taking outside capital, even if it's only family capital. So I do see those trends continuing, especially as the data out there with the growth of family offices over time, and people our generation grew up with technology, so I have a lot of predictions that I think more and more people, our generation and younger, are going to want to allocate towards technology as well, whatever you call that, venture, PE, whatever.
Yeah. So let's talk about allocation. Talk to me about VC within the context of the family office. Some of the pros and cons. I mean, let's go high level and we can zoom in.
Yeah, I mean, so for me, like, why do we do VC? It was a big thing initially because we're investing across the asset classes and we do philanthropic work elsewhere. So when we got into VC, it's about diversification and returns. So our why VC, we had to kind of go through a list, and I made it pretty clear that we want to diversify our assets. We want to seek 10x return potential out of direct deals or optimize for that, as well as 3x out of fund investments. And then, the other thing is we still have three operating companies that we wholly own. Now they're small cap. Two of them are manufacturing. One's
Mhm.
metal stamping, one's in the vinegar industry. And then we have a meat processing plant that is a retail storefront. So keeping a pulse on innovation and what's happening in industries is also a benefit. And seeing that from the venture funds that support some of these technologies, like really early stage, pre-seed, seed, has been also advantageous for us to make sure that we're keeping a pulse on just the constant changing business climate with the adoption of technology. And then, the other thing too, it's supporting entrepreneurs that we believe are solving real world problems that are important. And for all those reasons, like that was kind of our why we decided to get in venture. But there's all sorts of different reasons why families do it, philanthropic and not. But being clear about why you're doing it as a family office is really critical because typically there's other asset classes for other return profiles. And yeah, and you also just don't want to messy it together and call VC stuff and take on the same amount of risk with capped upside.
Dave, what do you in the conversations that you're having with family offices, what kind of percentage allocation of their assets are they dedicating to VC? And obviously every family is different, so I know that there isn't a single, but like what are you seeing?
Yeah, so to kind of bucketize them, I would say those that are above the 100 million in net worth or
Yeah.
AUM, I've seen them typically do the 5 to 10% type thing. Money managers, good money managers will tell you not to do more than 10%, partly because of the risk associated with it. But there's also families that are on like a Gen 5, 6, 7. Some of their mentality is wealth preservation, not growth. So VC is not actually a good asset class type thing. So some
Mhm.
of that is like, hey, why are we doing VC and what is our approach with our strategy? But I'm sorry, what was the topic again? The
Yeah,
question
just
that you asked?
understanding allocation and
Oh,
allocation.
yeah, the 5 to 10% is something that I've seen. It maybe skews lower, is where I was going with that for the families in the tens of billions that are more wealth preservation on Gen 5, 6, 7 or whatnot. And those typically have funds spin out that are often, managed by the family members or CIOs that they take outside capital. So it's a little different depending on the family office profile or type,
Yep.
but
Yep.
I've seen 5 to 10% pretty consistently.
Okay. And all right, so family offices, obviously, with venture versus public equities and otherwise, you've got longer lockups, you've got other risks. Let's talk about the challenges of investing in venture through your family office, and some of the lessons learned that you have experienced over time.
Yeah, absolutely. I mean, some of the challenges is like I'm a little bit of a history nerd and data nerd. So just like following the venture industry since I was a product manager in the corporate world in 2008, it was definitely helpful, but it didn't really hit me until I got in as an investor into the space. But quickly learned that like a family office stigma around venture is, hey, they're good for being an LP, but they can also be not the most sophisticated capital that can treat it like private equity and
Mhm.
all of a sudden do a bunch of stuff that are going to make the VCs very unhappy. And so sometimes historically it was a warning sign if family offices were heavily involved in a
Mhm.
venture deal that can be challenging. But so yeah, so family offices can look at as not sophisticated capital, but like How you learn is learn by doing. That was one of the biggest lessons that we had is learn by doing. And then for us, like, working with this network of over 200 family offices over the last 7 years doing venture, I've quickly identified a couple of themes of some common mistakes that I've
Yeah.
seen family offices make when getting into venture. First and foremost, it's not having a dedicated allocation. So whether it's a pool of capital that is just focused for that, it's important for that so that you can take a portfolio approach instead of just always doing off balance sheet. But that is one of the biggest ones is not taking a portfolio approach and getting a little too hot and heavy, like ready, fire, aim right when you start venture investing. It's like, whoa, we got to make sure we know what check size we want to do and how long we want to do this. But a lot of families will get kind of hot and heavy with a big check or two. And if those couple deals go sour in the next 18 months, they're like, why are we doing this? And so you'll see family offices treat it more like private equity when it should really be more of a portfolio approach, almost more like public securities.
Yeah.
Um, Another big one is adverse deal selection. It's something that all investors are battling, but especially family offices, constantly battling adverse deal selection. And when they're just starting out, it's one of the hardest things to overcome because oftentimes, as you know this, Josh, a lot of people in the family office world, they struggle with trust because everybody's trying to solicit them. So we only work with people that we know and trust. That can be good to a point. But if those people you know and trust are from other asset classes and you're going to be sourcing venture deals from them, it could be the very adverse venture deals you'll be seeing. So you want to diversify your deal flow channels and learn by doing, by putting yourself out there, even if it's not with close contacts that you've been working with in real estate or private equity for a couple decades. Even
Yeah.
though it's very comfortable to do, it's a slippery slope to create adverse deal selection. But in that same vein, only working with one or two venture fund partners can create the absolutely same scenario of adverse deal selection
Mhm.
because oftentimes, sure, they might send you a good deal that's doing well, but oftentimes they send you ones that later stage VCs aren't gobbling up or are struggling. So my view is investors are always battling adverse deal selection, and it's huge if you identify that early and try to constantly iterate on it and not get complacent. And that's another thing is like not iterating on your process, just saying, hey, we're going to invest in this geo or this category and go from there. I feel like the best investors are lifelong learners and constantly iterate and educate themselves. I think one of the best things that if you're just starting out today with your family office, starting with venture, one of the best things you can do is not, this is what we want to invest in. It's these are all the things we absolutely will not invest in, will not touch.
Sure.
The reason that's important is because then that can help you mitigate unnecessary meetings where you have personal connections where you have to feel like you can take it. Because the other thing that a lot of families kind of get tripped up on is once their network finds out they're doing venture, all of a sudden they can get a bunch of that adverse deal sent their way, and that can be very, very challenging situation. And then,
Hey,
the
Dave,
last one,
let
and
me ask you,
yeah,
let me ask you a question. When you talk about creating a list of what you won't do,
yeah.
are you referring to sort of sectors that may be in misalignment with your values and things like that? Or are you talking about size of deals, composition of a deal, and economics of deal? What dive in a little
It's
bit deeper.
both. It's both for us because I mean, we invest with a mentality that we want to be very proud to tell Gen 3 and beyond why we invested in this company and in this person because they're solving this problem. So yeah, it's ethics and values, but it's also just on stuff we know we don't know well and stuff.
Yeah.
So like a lot of hardware, especially pre-seed seed, when it takes a couple years to iterate and actually commercialize, we usually don't even consider type thing without a strategic family that's been involved for a very long time. For another one for me personally, not huge on pharmaceuticals. That whole industry just seems like the approvals, the other stuff, how it's like I'm just not fond of that industry, so I don't really look at it. And
It's like
same with
Warren Buffett, focus on what you know.
Yeah, yeah, and that's where we're trying to lean in. And I'm a tech data nerd, so I'm a tinkerer with technologies. So I also use it does, I don't have to use everything we invest in, but I use like I would say at least 50 to 60% of the stuff we invest in, or I've gotten very close to the customer experience where I can relate. The one last common mistake, though, that I wanted to just point out that a lot of families make when getting in is, a lot of these family offices are very prevalent with success, and in their local ecosystems are looked at for significant resources for a lot of different things, and that's great. But like some of these families take that position when they get in venture, like they got all the answers and capital's the big stick when like capital is just a commodity and it's more like about how you operate and what you do beyond the check. Are you going to be are you going to be dragging down the are you going to be an anchor to their sail? Are you going to paddle on their journey on their ship? Are you going to bring customers to the table? Like how are you doing it? So like that was the big genesis behind Family VC, being a random family office, finally learning capital is a commodity. How can I compete? Well, work with me. Every deal that I do, I put it in front of over 200 family offices through my newsletter and roundtables. That's one way, and that's one value prop that I have on why I work with Dave. So, knowing capital is a commodity is super important for families
Dave,
getting
what
in.
is, let me ask you, as a, if you think you're as a family, right?
Mhm.
And I'm getting involved in deals, what should I be doing as a family member, as an LP in a fund, as an investor in a deal? What are the founders, what are they looking for from a partner? And how can you be a good partner in the process versus just like let's put the mistakes we make, but how do we be good partners?
Yeah, I mean, the best thing you can do is be super intentional about what value you can add. The worst thing you can do is say, Josh, founder, how can I add value to what you're doing? That creates actually more work for the founder and can kind of be stressful. Where I reverse it and say, hey, I just committed. I'm super excited to use to be an investor, but also to be a customer. Is it okay if I share this with these 10 other families who also do invest in this thesis area? So I more lead with the value,
Yes.
instead of asking. So asking and constantly harping or treating it like private equity, that can be overbearing. So sometimes the best thing you can do is make sure you stay in the loop with consuming the updates,
Yep.
responding to the updates to let them know that you're there and not just consuming it, and also just not pester them as well until there's something where clearly, hey, I can add value by this way, and then going to the table. But if you send like news articles, hey, have you seen this competitor or stuff like that? Oftentimes founders or VC managers will just feel uh, that they have to respond to you, and then they'll start looking at it as a chore, and then they won't look at you as a teammate or a partner. They'll look at you as a task item that they have to respond to. And I think being
Makes
very
a lot of sense.
intentional about where you can add value or where you can paddle along the journey or the ship, and then where you can get out of the way is important.
Dave, I don't know space the exact timing, but 2001 peak valuations have obviously seen a lot of things come down. What are the next 6, 12, 18 months look like from your vantage point, looking at deals, talking to a lot of families and founders?
Yeah, the next 6 to 12 months, I think there's going to be great opportunity. There's a lot of fear in the market. I mean, you look back last year, and the VC market is no different. The macro definitely impacts it. I mean, you look just last year, Silicon Valley Bank that banked half the industry, they got it over their skis and now they're gone. Some like the crypto industry got destroyed due to FTX with notable blue chip VCs in that, and that happened. So like the confidence level or the fear level right now in venture is pretty high, but I also think that screams opportunity. If you look at a lot of trends in historical data, and even throwing in the pandemic creating behavioral changes, this year, next year, and 2026 could be some great vintage opportunities when it
Mm.
comes to venture investing, especially like looking historically after what happened in 2008, even after the dot-com bust. Like, so there's some trends there, but like moving forward, I'm continuing to see more reasonable valuations and stuff.
Right.
Sure, you're still going to have your 100 to 200x plus on AI deals where there's blue chip VCs involved, but a lot more are just in the realm of being able to grow into. So a big trend that happened in 2021, Series A through D companies, their valuations were 20 to 60% higher than they are today. Well, if you raised a Series B at a very forward-looking valuation, which was what was happening in 2021, all of a sudden it was very hard to live up to that. So the last like 12 to 18 months, it's been bridge and down round central, especially for family offices. So that's another thing that's been very challenging for families that have gotten into the space recently is there's these bridges everywhere, bridges galore, but like, do they actually lead to anywhere? Or and like, so there's a lot of that going on, but I'm starting to see that kind of dissipate and the upswing I think return where it's more true fresh rounds and not the down flat rounds type stuff or bridge extensions. But I'm excited for the next 6 to 12 months. I'm excited for the next 5 years, but even more so, especially once we get past this election cycle and people understand more about certain policies and stuff. I think the activity will be great in venture, especially coming from the family office world.
So you and I were talking about this briefly earlier, but we've got, according to Deloitte Private's report, 8,000 family office expected to grow by 75% in the next 5 years. They're talking about 3.1 trillion in AUM now, growing to 5.4 trillion by 2030. Right now,
Wow.
hedge funds have roughly 4.3 trillion as of Q2 2023. The impact that family offices have in the investment ecosystem is significant. As that wealth transfers between generations
Mhm.
and as family offices hold more of that wealth, how do you think it's going to impact venture?
So, so venture is also gone. So I think there's going to be a consolidation on venture, but even without the family office stuff, there was a huge influx of new VC fund managers over the last several years, and all of a sudden it's not as sexy and fun to be a fund manager these days because everything isn't up and to the right. But with that, the VC market. I'm sorry. The question that you had again.
Is really how do you see as family offices begin to control more and more of that wealth, how does it impact venture?
So I see family offices being a complement, not a replacement. You will have the family office individuals that set up their own fund that take outside capital, but they take limited outside capital, is what I've seen. But there is going to be a huge consolidation that happens on the venture side, the fund manager side here. And I don't know, who knows too with how the family office world. I don't know, like the multifamily office space, I don't know that well because I work with a lot more single family offices. But the
Mhm.
multifamily office space and the wealth managers of the world, they could also get a lot more involved because I am seeing a trend where I'm having more wealth managers reach out saying clients want access to venture deals. So I think through whatever mechanism, whether it's a fund manager or directly themselves, family offices are going to be active in venture. And those that take kind of a two-prong approach, what I call it, if they want to do direct investing, they should also be doing fund investing just to learn, and all sorts of advantages to doing that. But those are the families that I see are really leaning in, and I think there's great opportunity in the coming years here with venture, and that's part of the reason why I'm building Family VC to work with a bunch of these family individuals like myself who want to really lean into venture in the next five to
Yeah.
10.
So, Dave, I'm gonna bifurcate this next question between funds and deals.
Yeah.
Talk to me a bit about your due diligence process on a manager versus a specific deal.
Yeah. So, starting with a manager, I mean, manager and founders, the big thing that I look at when analyzing is, do I want to work for this individual type thing? Is this somebody that I want to run through a brick wall for? So like that's first and foremost, because I mean, what I say to people is, and you know some of this, Josh, but when you work with family and invest with family, you're risking a lot more than just capital. So like working with people that make it easy to champion or empower you with data and transparency makes it a lot easier. So I legitimately review and analyze both founders and fund managers where do I want to work for them? Because the other thing is a lot of people don't realize, but venture is a game of sales. And I'm not talking sales of like you need this square peg for this round hole. No, I'm talking about matching value to need. And
Yeah.
if and selling people on your vision for your company, selling investors, selling customers, selling employees. Some of the best founders are good recruiters on their vision and stuff. So that's also why I have that mentality of like, do I want to work for them? And like, are they getting me motivated to bring it and help them any way I can? So that's a big thing. Another part of the diligence process can vary anywhere from 2 to 4 weeks, really
Okay.
is how I look at it. And depending if it's a formal round, if it's an opportunistic note, stuff like that, that all depends because then you can have rolling closes versus, hey, there's a close date because it's a price round. So I try to do most of my due diligence in under 4 weeks. I can do it as quick as 2 weeks. It's not as ideal these days, but that is the process. Now, when I involve the family, what I do is we have this process where I have these checks and balances where if I get to a certain level, then I create an investment memo. Then the 5 members of the investment committee get access to that memo. They review it. If it's worthwhile, then we have a meeting to where we discuss the memo and then recommendation. But oftentimes, 98% of the stuff doesn't get to that level. So a lot of it is just me individually shepherding along. And I mean, I have a thing too where like I absolutely trust my gut. So if I meet with a founder a second time, I should be more excited about wanting to run through a brick wall and support them and work for them, not
Yeah.
am I teetering or am I losing confidence type thing. So, but I could go on for hours about due diligence with some of the specific stuff, especially because I look at a lot of non-qualitative or more qualitative, non-quantitative stuff because
Yeah.
it is early stage. And yeah, but that's a part of my due
You're betting on the
diligence.
people in many
Absolutely.
ways and the teams that they're building and their ability to build those teams and kind of corral the resources necessary to take this idea to fruition. And yeah, takes a lot of human energy and inspiration to get that to
Mhm.
work. Yeah.
Absolutely.
Dave, what is an unpopular opinion on family offices doing venture that you believe in?
So an unpopular opinion, moving forward, I think it's still going to be true. And I even talked to actually a family office that you introduced me to today that reaffirmed that. But I think families are going to be offices are going to be very value add investors moving forward in venture, and those that figure out and really lean into where can I add value or where will I get out of the way type thing.
Mhm.
Because in the venture industry, if you go online, there's a lot of memes, or it can be very cheek and tongue to say, oh, how can this VC add value other than capital? How can they add value? Well, as you know, family offices are filled with a bunch of entrepreneurs that oftentimes have operating companies. So they think in terms of customers, revenue, distribution partners, not what
You
is
mean
the next
business
round.
models?
Yeah, business models. What is the next round's valuation and
Yeah.
who can we get to mark this up type thing. So yeah, I am seeing that. And that's something that I'm organizing with my family VC group so that if you had a deal and said, Dave, it's in this industry, it's at this stage, I can come back and say, Josh, I got 5 families that look at that stuff. 2 of them actually have operating companies that are in the industry. I can do a double in opt-in intro if you want. So it's really about building this community and this network of value add. And I'm a firm believer that family offices, especially the sophisticated ones, will lean in and genuinely add value and be supportive venture partners to both fund managers as well as founders in venture.
I love it. Before I ask my last question, real quick for everybody, please feel free to use the Q&A at the bottom of the screen if you do have any questions. I fielded a couple and tossed them over, so please feel free to use that. Dave, if you're going to give families, family offices, one piece of advice, what would it be?
If I had only one piece of advice,
You
I
only
would
get
always
one, Dave.
if it's one, you know how I roll, Josh, family first. So optimize for family continuity would be the one. And whatever you're doing. I mean, even when I started doing the venture stuff after I convinced my family for 2 years, I mean, the mandate was don't screw up everything else we got going on with what you're doing and putting in guardrails, putting in processes. So really optimizing for family continuity is important. Anything that you do in the family office. And that's why I have a ton of respect for what you're doing at Family.Inc because of your background with your family and the success you've had. You're at a very unique spot to give input that actually also relates to the family. You know, there's a lot of these consultants, and I won't name certain companies, but like that just think, hell, here's the playbook. Go implement it at your family office without taking into account the family dynamics and the family member interpersonal relationships. And that is crucial because, I mean, the dirty secret in the family office world is a lot of these families either operate as a family or they operate as a business. They don't do both well. Or not many do both well. So that is something we've talked about. I mean, even last year for our family, we had to clearly delineate, hey, what is our swim lane when we're working together?
Love
So
that.
when we're family together, we aren't drowning each other because of what we're doing on the business side. And
Yep.
it's how my family operates. It's nearly impossible not to talk about something business related on a holiday because if you have a meat market and it's the 4th of July, well, how are the sales yesterday? But we got good weather. So it's just like,
Yeah.
I would say family continuity over everything.
This is I first of all, thank you. That it certainly wasn't a teed up pitch. I want everyone to know that, but I will say that it's amazing. I have the opportunity to meet with a lot of family offices every week, and the challenge is usually not their allocation or their operation or their tech stack.
Hmm.
It's family, and to get outsized returns, you got to communicate well and be cohesive as a family and work on those dynamics.
Hmm.
So appreciate that point of perspective and feedback.
Yeah.
Thank you, Dave. Really appreciate it. Thank you for joining us. I will pitch for Family VC here just because I think it is important. Building an ecosystem of a team that you can talk to about deals and look at and source. Hey, what do you think about this? And what do you think about this founder or this manager? Is really important. And I love what you're doing. I love what you're creating. I love the fact that
Thanks. Appreciate
you
it.
are nationwide in terms of your reach and who you're speaking with.
80% of the group is outside the Midwest, believe
Is
it or
that what it
not.
is?
Yeah, even though I'm based in Wisconsin, don't you know there, hey there. But
Oh, sure.
80% is outside the Midwest. Yeah. The other thing too, Josh, that I'm really excited about, like there's some statistics out there that only 35% of next gen right now in the family office world in North America actually have influence on investment decisions. So that number is going to tick
Mm.
up. And that's also why I
Yeah,
think more family offices are going to get involved. Now, in Asia, it's like 55% of the next gen is involved, but that's going to slowly tick up. So I'm also really excited about that. And this community helps some of those people better champion it with their family internally so they don't get egg on their face and make some of the same mistakes that I did early on. But I was very fortunate to have a family that has allowed me to learn by doing. And yeah, now I'm really excited for the next 5 years.
that's fantastic. Dave, thank you. And thank you all
Yeah.
for joining us here at Family.Inc. I encourage all of you to take a look at our website, Family.Inc, for more interviews and resources focused on enterprising families. Additionally, after this conversation, you receive an email from us asking for your feedback. We would love for you to participate just so we can help design content that you're looking for. So, Dave, thank you. Great to see you. I
Awesome.
hope all is well in Wisconsin. Take care.
Yeah. Thanks so much, Josh. Appreciate it. Take care.